Working Man Investor. Today's video, the bond market is flashing warnings not just to the United States, but to the entire world. So I got an article here that I just pulled up about the Japanese bond sell-off and how it's a warning to the world. I'm going to go over it here and I'm going to relate it to the United States and some of the other videos I've talked about how we're starting to struggle to sell our treasuries. Our deficit is at 36 trillion. And looks like it's going to go up, and it's getting to be a real problem. This is how countries go bankrupt. Now, not saying the United States is about to go bankrupt just yet, but we're on an unsustainable path. So in this article, even though it's about Japan, relates very similar. It's still bond sales. Countries' bond sales are still countries' bond sales. So we'll get into this. The title is, this is from today, Japan's bond sell-off is a warning to the rest of the world. As yields surge and demand crumbles, Japan is becoming a case study in what happens when investors lose patience with massive deficits. Right there in the first line, there's a lot to unpack. When it says yield surge, all a yield is the interest rate that a bond pays the investor. And when demand crumbles, what happens is all these bonds are sold at auction. Doesn't matter what country. So if you have a lot of people coming out to bid on them, the price of the bond will go up, it'll get more expensive, and the interest rate, the yield, will go down, it'll get cheaper. That's good for countries because they can finance their debt. The way they finance their deficit and their debt is through bond sales. That's good because the interest rate is low, it's a lot cheaper. When you don't get a lot of demand, and when demand is crumbling like happened here in Japan and happened to the United States about a week ago, we auctioned off, I think it was $16 billion in 20-year treasuries, and the auction failed. Couldn't sell it all. What happens when that is the case, when you're not getting a lot of people bidding on these bonds, the bond price goes down, so it gets cheaper to buy the bond, and the yield, the interest rate goes up. Great for the investor. Horrible for the country, because then the interest rate is more expensive. Servicing your debt is more expensive. It leads to bad situations. So back to this article. Demand for Japan's 40-year government bond plunged Wednesday to its lowest level since July, reinforcing fears that the appetite for ultra-long-term Japanese debt is evaporating. Here again, when you buy treasuries, now I buy T-bills and things that are like 1 month, 2 month treasuries. It's where I'll stash my emergency fund and things like that. Those are relatively safe. Just simply as far as dealing with inflation, simply because they roll over so quickly. When you start talking about a 40-year bond in Japan, you're going to buy something and draw interest on 40 years. How confident are you that if you hold a bond for 40 years or 30 years like the United States has, or 20 years, which is why the 20-year bond auction failed in the United States, that the interest rate that it is paying, whether it's 4%, is going to be able to keep up with inflation? If you buy a bond and get 5% interest, but over the course of you owning it, inflation is 12%, and I'm just making these numbers up, that's bad for you. You've lost money by holding that bond. So what's happening is as these countries are getting more and more in debt and their deficit is getting bigger, bond investors are demanding a higher interest rate, and they're doing that by not showing up to auction. They're just looking to see where it's set, and they're saying, no, we're not going to come here and buy these. So then the Treasury or Japan central bank has to put it out with a higher interest rate, and that just continues until equilibrium is found. And then refinancing deficits gets really expensive. And this is critical in the United States, because this year we're $36 trillion in debt. We have $9 trillion coming up to be refinanced. That current debt that's being refinanced is in roughly 2.5% interest rates for treasuries. We're going to have to refinance that. As of now, the 10-year treasury is about 4.5%. I think the 30-year is 5.1%. So as we go to sell this, our interest rates are going to at least likely, but not so much for the 10-year, but for the 20 or 30-year, it's going to double. And for the 10-year, it's going to get close to doubling. Again, more expensive. I want to get back to the article, and I'd mentioned this in another video, but it's just such a good example, I'm going to use it again. Think of a country's treasury and the rates as your mortgage. So if you lock in a 30-year fixed rate mortgage, do you want to lock it in at 2% interest or 9% interest. You want to lock it in at 2% because your monthly payment's going to be less, and the interest that you pay over the course of the mortgage is going to be less. It's going to be cheaper. It's going to save money. Because of this, you have now more money for disposable income. You could take that vacation. You could buy that new car. You can splurge on your kids. You can go out to eat more often, as opposed to if your interest rate is 9% and your mortgage is more expensive every month. Same way with a country. When we lock in low-rate treasuries at 2.5%, or Japan locks them in at whatever percent they want, and it's cheaper, they have more money for social programs, for infrastructure programs, things like that. Across the world now, we're starting to see, not just in the United States, but as this article proves in Japan, investors are looking at all these countries' deficit and how in debt these countries are and saying, no, we no longer want to loan you money, because that's all a treasury sale is. You give the government money, it's a loan, and they pay you interest. We're not going to do it for 3-4%. We want more, because you're so in debt, you're now considered a bigger credit risk. I'm more concerned about you paying me back with inflated dollars that will buy less and overall be a bad investment for me. So now I'm going to take this money, I'm going to put it in real estate, or I'm going to put it in the equities market, or something like that could possibly give me a bigger return, because I don't trust you as much as I used to, because you're so in debt. And we're seeing that now with the big, beautiful bill. The bond market's starting to have a fit. And it's because it adds like $4 trillion to the deficit. Now, I understand what they're going for. They're going for growth, because growth is the best way to get out of debt, grow your way out, which I won't get into too much because I just did a video on that. But that's a lot harder to do. So not just us, Japan, the United States, we're all reaching that point where we've either got to start raising taxes and cutting back spending, or something. We got to lower our deficit, or our treasuries and our bonds are going to get much, much more expensive to sell and difficult to sell. So back to the article. The lopsided supply-demand dynamic followed a similarly disastrous 20-year auction last week that was the worst since 2012 and comes months of heavy selling across Japan's super long bond market. So bonds have a secondary market after you buy it at auction. At any point, you can sell it in the secondary market. You sell it for a little bit less than you paid for it. Is the way it works. I won't go into that, but basically people are holding these bonds that are for 40 years that maybe they bought 5, 6, 7, 8, 10 years ago. They've held it and they've looked at the country's debt, which is probably going to lead to inflation, and are thinking, we're no longer comfortable in these 40-year bonds. Let's dump them. Let's sell them on a secondary market to somebody else. So if you're holding a 40-year treasury bond, or in this case a bond just from Japan, or a 30-year treasury from the United States, and you feel this way, and you sell it in the secondary market because you're worried about the deficit, you're now not likely to enter the next auction to buy a fresh new treasury or Japanese bond. Again, we do this, we don't finance our deficit. We don't get to borrow more money. We don't get new money coming into the system to do our social programs, our infrastructure, things like that. Same with Japan. So together, the flops suggest that confidence in long-dated Japanese government bonds is breaking down, despite an emergency signal from Japanese Minister of Finance that it may scale back issues of longer maturities to calm the market, and briefly announced the announcement briefly did rattle markets across the globe, helping push down yields across Asia, the UK, and the United States. So as Japan's saying, we're not going to sell as many 40-year bonds, it kind of calmed the markets a little bit. So they'll go shorter lengths, like 10 years, 30 years. And I believe that Japan also has the T-bills for the United States, where they mature in 1 to 3 months, 1 month to a year type of thing. Analysts now say Japan's shift towards issuing bonds with shorter maturities could become a global test case for how governments manage growing fiscal stress. But if Wednesday's auction is any indications, investors remain unconvinced because demand for long-end debt is still deteriorating. And while it may be less coincidental And it goes on to say a storm of chatter on X and YouTube and Google where armchair analysts, I don't like that part of the article. You want to write an article, this is a pretty good article, but I don't think that hearsay that you're seeing on Google and X belongs in this article. Anybody can do this. Anybody can start a YouTube channel. I would rather have them talk to a professional economist or somebody or bond investor and gotten that information rather than say a storm on social media. Anybody can cause a storm on social media. We've all seen that. I don't like that part. So then it goes on to give a quick explainer. Yields have surged and demand is evaporating. This is what I talked about earlier. Japan's 30 and 40-year bond yields have recently soared to record highs of 3.2% and 3.5% respectively after being stuck near zero. So that the interest rate was usually around zero. It then goes on to say that their policy is to sell their bonds at about 0.5% interest. So basically nothing. And now they're at 3.2 to 3.5. So this is going from a half a point to 3.2 and 3.5%. That's a big jump. And it says auctions are failing with long-dated debt buyers stepping aside even when supply remains strong. So basically, the way the Federal Reserve did this, and I'm assuming Japan did it the same way, was on that auction for the 20-year treasuries that failed, is they allocated $16 billion in treasuries, and they didn't sell it all, despite it was there. They didn't have the demand. So that's what Japan's experience. We have X amount here that we're selling in our bond, and the investors are not showing up and buying it. That is bad, because when you do the next auction, you jack that interest rate up and you lower the price of the bond, and your debt becomes more expensive, and you're trying to find equilibrium. At what point can we sell this debt to the investors? And how expensive is it going to be for the country and devastating for the country's future? Because this can bankrupt the country. Make no mistake. So what's more interesting, the four major Japanese life insurances reported $60 billion in paper losses last quarter, quadruple last year's total. Nippon Life alone saw a $25 billion in unrealized losses. Not good. Government debt is enormous and stagflation is looming. Stagflation odds are increasing here in the United States. What stagflation is, and this explains it, is it's low growth, high inflation. So it just basically means your economy is not growing very much. There could be mass layoffs, but there doesn't have to be. A lot of people associate stagflation with a bunch of layoffs. That certainly can happen, but it could just be people's working and they're not getting raises. And in the meantime, you have inflation going up. And as it explains here in this article, that is the worst case scenario for any central bank in the United States. It's the Federal Reserve, because you pick your poison, basically. You can jack interest rates sky high, which Paul Volcker did in the 80s. And that will shut down borrowing and decrease the amount of money in the system. One person's spending is another person's income. What that does is that'll crush inflation, because you get fewer dollars chasing goods and services. But it is recessionary. You're almost guaranteed a recession then, and at that point you will have job losses. The other thing that you can do is you can cut interest rates, really flood the economy with some cheap money, and asset prices, stock market, gold, silver, commodities, real estate rip higher. The economy rips higher, and inflation really rips higher. So you got to choose. And personally, I think raising interest rates like Volcker did in the 80s is always the best way to go. I'd rather break the economy and then try to repair it and let it repair itself than just let runaway inflation. So I'm going to continue to read this article. This just repeats what I said. It says, with a jet GDP at 260% and the Bank of Japan already owning more than half of the outstanding Japanese government bonds, the country leadership is boxed in. The Bank of Japan is no longer stepping in to buy more. Debt to GDP, the way economists look at this, if it goes up to 100%, if it goes over 100%, your economy is not growing fast enough to keep up with the debt that you're bringing in. And at this point, they're more than 2.5 times more than what they were. Not 2.5, but they're 160% more than what they were. That's extremely bad. Extremely bad. Japan's in rough shape. So then it goes on to inflation is up while real wages are down and GDP is shrinking. This is stagflation, GDP. GDP shrinking, just like I said, and it says here, it could just be you're not getting raises. Your employees just aren't getting raises. It doesn't have to be high unemployment, but it often is. So that leaves Japan trapped between raising rates and risking a recession. Like I said, they can raise the rates and crush the economy to crush inflation, or holding steady and letting inflation go higher. If inflation goes higher and you're not getting a raise or you're out of work, there's not growth, the families are struggling to pay their bills while inflation is ripping higher, that's extremely bad. So you have to then stimulate the economy so that people can at least get more money, whether it's through raises or stimulus to keep up with inflation. But that just feeds upon itself. So it's a really nasty situation. So Japan's bond turmoil may offer a glimpse of what's ahead for other debt-heavy economies. United States, our debt to GDP, I believe, is 122%. We're over 100% too. Not good. Like Japan, the U.S. is flooding the market with long-term debt at the moment. Buyers are growing fatigued and weary. Last week, I mentioned this last week, low demand for Treasury auctions and a Trump-backed deficit-swelling tax bill. This is the big, beautiful bill. Pushed 30-year yields above 5% and 10-year yields past 4.5%. While yields have since dipped, they've gone down, the bigger problem of too much supply and not enough demand remains. And if Japan can't sustain confidence, even after decades of ultra-low policy, it raises urgent questions about how other governments plan to survive their own reckoning. So Japan looks like they're going to try shorter-term bonds. It's going to be kind of an experiment to see how this works. If this works, then maybe the United States could do this. This is a really bad situation, especially to the United States. If we cannot sell our debt, we have no new money really coming into the system. There's two ways new money comes into the system. This is the Cantillon effect, which I keep harping on because it's an economic law you really need to be able to wrap your mind around. And when you do and you can process this information, it's going to help make you a better investor. Richard Cantillon studied economics back in the 1700s. He noticed that the way states got new money were for two ways. One, they produced and sold. They exported. They sold to foreign nations or foreign states. This worked out fine until people started to move into luxuries, meaning they started to buy newer, nicer things, and everybody's wages started to go up because everything got more expensive. When that happened, these countries that you were exporting to built up factories and started manufacturing on their own just to keep yours out because they could do it cheaper, which eventually happened, and then you lost that balance of trade. And then in turn, what would happen, it went 360. They would then start exporting it to you. And it would start moving around in our economy, and it was cheaper because their standard of livings were less. So that's how we lost manufacturing. This is an economic force. This is why tariffs aren't going to work and bring mass manufacturing back, in my opinion, to this country, because we need to be able to sell in the global economy for our economy to go boom. Now, what do I mean by that? We can't just add some warehouse jobs and sell it all domestically at these rates to the American buyer. You need to be able to sell it in the global economy. France, Japan, Europe, Japan, China, Mexico, India. You need to be able to produce and sell. That's how you get a manufacturing boom. The whole world wants your products. So then you're manufacturing stuff and you're selling it and you're bringing in new money. Okay, so your people are getting richer. We can't do that because places like Mexico and Malaysia and Vietnam can all make it cheaper. So yeah, we could get to the point where we can manufacture it here, but how are we going to compete with those other countries when it comes to selling it to Europe? If we're all making shirts, all right, and we go to sell it to Europe, and the Mexico can make it jeans and shirts for $10 each, and we make them for $25, when they hit the retail stores in Europe and they're the same products, same quality, what are the Europeans going to buy? Well, it's human nature. They're going to buy the cheaper products. This is why I don't believe manufacturing is coming back in mass. So that's one to the Cantillon effect. The other way he noticed, and this has to do with treasuries, that new money comes into the system, it's through the discovery of a gold or silver mine. You find this gold or silver mine, the miners, the smelters, the refiners, the mine owners all start pulling that money out, and it starts circulating through the global economy. Okay? Prices start to go up, but that money starts exchanging hands, and other people start getting a hold of that money. So everybody gets more wealthy. That's fine until that mine runs dry. Then you all fall into misery and poverty. Those treasuries are our modern day gold and silver mine. When we auction it off to our citizens, to our businesses, to foreign countries who buy a lot of our treasuries in the past because we're the reserve currency of the world, so they get a lot of dollars by selling them to us. So they turn around and then loan it back to us through treasuries, through foreign businesses. Big foreign investors will often invest in treasuries. All that money keeps coming in, and then we can do infrastructure. We can do social programs and things like that. We have money to spend. If we can do it because it was always in such demand. Remember what I said about treasuries. When they're in demand, the price of the treasury gets more expensive and the interest rate gets lower. So we're borrowing this money back at a very low interest rate. Our debt service was low. But now because we're so in debt, after so many years of doing this, 36 trillion in debt, that the investors are looking at going, no, you guys are too in debt. We're afraid you're going to pay us back in inflated dollars, which are going to be worth less and make this a bad investment. Jack that interest rate up. We want higher interest rates if you want us to buy your debt. Because of that, our debt service to pay our debt is getting too expensive. So these treasuries need to sell. And this article proves it isn't just a United States problem now. It's a Japanese problem because they're so in debt too. The whole world's in debt, but other countries are worse than others. So we need to be able to sell this debt, and ideally we need it at a low interest rate, because we'll get to the point where the only way we can bring money, the government can bring money into this country right now, is through taxing us and tariffs, which just got put on hold last night. Anybody who follows the news, because of the 3 judges, which then I guess tonight had another temporary restraining order. So now the tariffs are back on. But tariffs, at least on the level that President Trump wants to do, are now up in the air. So it may just be taxes and whatever tariffs he can legally do to generate income. We're going to get to the point where if interest rates get too high on this $36 trillion, that the money that we bring in will either only cover the interest payment or won't even cover the interest payment. Okay, so we're not going to pay the principal down. We're just going to get further and further, and things will just keep getting worse. This is one of the ways countries can go bankrupt. So it's something to keep an eye on. What I need to do is I need to do a video of what I think the central bank might do here in the future with this, and the steps that I'm going to take to protect myself as best I can financially. So that's what I got for you today. Working man investor, keep grinding, people.